Douglas. Good luck.
Good morning. So great to be here, and when I was asked to moderate this panel, where Charlie is, I said, "What'd you do? Like, give me the suits? You're gonna make me think first thing in the morning." We've got 25 minutes. I've got an extraordinary panel, so we are gonna jump right on in on this. And Frank, we were talking in the back. What makes us, you were on a bit of a buying spree in 2014 for acquisitions, was it? What makes a startup an attractive acquisition?
So we do all sorts of different acquisitions, and I guess with my colleague Doug Ghertner here from Change, the first criteria in any acquisition is a well-dressed CEO, so Exhibit A. But we have an ability as kind of a platform company to look at things where we're going to take a lot of cost out of businesses that overlap with what we do. We also have the flexibility, because we generate a lot of cash in these kind of core businesses we have, to take a longer view on some areas that are highly strategic. So we spent a lot of time thinking about the Emdeon strategy and what's going on in healthcare, and circled around that the consumer is going to be an exceptionally important piece of healthcare. It's going to be a very fast-growing market, and we need to find someone who can help us get more engaged with consumers. And really looked at the whole landscape. Came around and found Doug's business, and it wasn't just love at first sight. We had talked to Doug 2-3 years ago when the business started up. Our thinking evolved to the point where we knew this was a critical asset. Doug's business had grown to the point where it validated in the market that actually there was good uptake for the business. The size of the market had actually become more clear to us over the last couple of years. So all of that converged, and it was really a function of our thinking evolving in Doug's direction, Doug building a quality business, and then those two things aligning. But from our perspective, we need to be in faster growing markets than the ones we dominate, because they're kind of mature markets. And so we did our homework and circled back and ultimately wound up buying somebody local, which had its own benefits, because it just, the cultural fit was spectacular.
And we're going to talk more on that. Joe, I'm looking at you. So you weren't even on the market.
No, we were not for sale.
But you sold out.
Of course we did.
Talk about that.
Well, as a serial entrepreneur, one thing you learn is maximizing shareholder value and being responsible for returns, especially when you have OPM, other people's money. And if I can say one thing to any of the aspiring entrepreneurs here, is the day you take a check that doesn't have your name on it, you are now responsible to that check. And I was actually approached by the CFO of Blackstone originally, Lawrence Tozy, LT, the infamous LT. And LT has a passion for the industry that we're in, and Blackstone has a financial innovations fund, and they wanted to do an $8 to $10 million investment in our company. But lo and behold, they were doing a deal with Ipreo at the time, and LT just literally looked at me and he says, "I'm either going to buy you now or buy you in 2 or 3 years with the capital I put in you." And when the largest client in the country says that to you, you listen.
You say, "Where's the check and how big is it?"
Yeah, well,
Show me.
it's not that easy. You wish it was that easy. It's never that easy.
I think that actually gets to an important point. Like, LT was going to buy the company, now we'll buy it later. I think one of the things with Change Healthcare, and I think for folks who are entrepreneurs, it's important to think about this and try to think about where your long-term home is going to be for the business. And being a public company is a very tough thing nowadays, and it's not all it's cracked up to be in many ways. There's value to it, but it's also it's like everything else in life. It's a net positive. But I think Doug had thought long and hard about that. And when we came knocking that we really wanted to do something here, I remember talking to him and Howard McClure, who was his chairman. And they said, "Look, we've reflected on this, and what you're doing in healthcare, Emdeon, is the place for us to be, and we need to be in an organization like that." And there were a whole host of attributes they had thought about. We kind of checked all the boxes, and that enabled us to streamline the acquisition discussions.
Yeah. So, kind of throw this out there, and particularly looking at you guys and Robert down at the end in terms of Blackstone. But when does the process really start? When do you start kind of looking around, thinking, "All right, well, here's how we're going to grow. I'm going to, acquire someone." When does that, in terms of, there may be the tech product, there may be, like you say, good, what they do fits, but when do you really start that cycle? If
I could, I'd say it starts with the strategy. So in the case of Shareholder Insite that we acquired 8 months ago, the strategy was we provide workflow efficiency to all the participants in the capital markets, but we don't serve the alternative asset community at all. How can we get it so that Blackstone, Kleiner, Sequoia are our clients? And then from that, you look at who are the participants in that market. Shareholder Insight was a leading platform for valuation and workflow software. And that was really the genesis, that and the force of LT's personality saying, this is the company, that got us focused on them.
The one comment I would make for the entrepreneurs in the room is that as you look to start your company, that exit is going to happen at some point in the future, hopefully. But from day one, you need to build your company with that exit in mind. So you need to build the reporting, you need to build the financial metrics, you need to think about what's that story you want to tell today, but also what do you want to tell in the future. You know, I think one of the things that worked nicely in the context of our deal with Emdeon is we had invested a lot of time and effort in having the reporting in place from a sales and a pipeline management perspective, from a financial reporting perspective, such that when Emdeon decided that they wanted to dig in, that diligence process was incredibly swift. The value there, we've got a limited amount of people and resources, and so you don't want this to be a distraction at this incredibly important time in your business. So as you go out there, those investments are worth making on the front end of things. I mean, you think about Joe's business, we were a client as well. And it was incredibly valuable for us to understand what that cap table looked like, because that was going to be something that Frank and his team wanted to have a perspective on and understand and dig into. And so just think about that as you are looking at your company. The planning for the exit starts on day one, not 3-4 years down the road.
But can you overplan for an exit as a startup founder? Instead of building a company, you're building for an exit?
Yeah, I mean, you can. I believe you can focus way too much on the exit. I mean, you got to focus and build the infrastructure to be ready for an exit, but you got to focus maniacally on the business and building the business. I meet with so many entrepreneurs that have big itis that are constantly wanting to raise capital and sell the business, and you're like, guys, you're coming off as an act of desperation, and the status of the ego and the outcome is far more important than building a successful business. You got to build a business to last, regardless.
Yeah, I would make the distinction between what Doug is talking about is your fundamental corporate infrastructure, and what Charlie's talking about, right? Charlie. What Charlie's talking about is your corporate strategy. Your corporate strategy has got to focus on building the fastest growing, most cash generative business you possibly can, and have a good cohesive strategy around that. But a lot of people, and certainly folks who set up businesses and have the kind of the drive to set them up and start them themselves, are passionate about what they're doing and not so excited about corporate infrastructure. Well, when we as an acquirer or a private equity fund or a venture capitalist descends on the business and wants to invest in it, they're going to see that business through the keyhole of finance and metrics. And you have to be able to report those metrics out. You have to have the infrastructure in place. And if you don't, you're going to lose credibility. And we looked at a great business as an example earlier this year, 30 million EBITDA, really interesting business, run by a founder, great space it was in. But the founder had functionally run the business because he just knew the space so well and couldn't articulate how he was going to hit his numbers through pipeline and backlog and other stuff. And we just can't underwrite, gut intuition. And so it's important to have those infrastructure pieces in place so you can report out those numbers. Even though you don't need them every day, someone's going to need them in order to acquire the business or invest in it someday.
All right, Robert. Why the heck does anyone want to become the CEO of a private equity-backed company?
Well, I just want everybody to know that I'm off to the right over here because I am other people's money, as Joe mentioned.
We got our big comfy chairs because you got the cash, yeah.
These are the people you want to be because these are the people who create value, and they're the people that we at Blackstone look to invest in. So if you get some time to talk to them, you don't need to talk to me, talk to these folks, and you want to use them as your role models. So what we do when we buy companies is we always want to invest in good businesses that have a lot of good things going for them already, have a lot of good organic growth, and free cash flow is a very important thing that we focus on as a later stage private equity firm. But we also think that we provide benefits to companies, and we really provide benefits to CEOs of companies in our private ownership structure, and I think 3 ways. One, when we're investing in companies, we're investing in the management team to continue their strategy, and we support them in doing that. But we also can bring to bear, given our experience, our portfolio operations group, et cetera, we can bring to bear ideas and initiatives to help them grow their businesses, either through more organic growth, doing add-on acquisitions, which a lot of these companies do, and in other ways. The third thing we do is we provide capital to companies to grow. We make obviously big capital infusions when we make our investments in companies, but in most cases, we have more capital to put into companies to help them grow after we make our initial investment. And then I think the third thing that we do, most importantly, versus being a public company and the CEO of a public company, is we provide time and patience for management teams to do what they need to do, which sometimes don't provide serial quarterly increase in revenues and earnings. They might take a couple of years to get done. Sometimes you go through a rough patch. And if you're in a public company and you're dealing with quarterly reporting and the impact on your stock price, that can be very distracting. So I think one of the main things we and people like Blackstone, other firms like Blackstone, bring to the table is the patience and the time for management teams to do what they need to do out of the public spotlight.
Please jump in.
If I would just add, I would also say in the experience of Ipreo being acquired by a partnership between Blackstone and Goldman Sachs, which is like being backed by the Death Star now, is, it adds two things. One is scale and influence. I mean, the ability for Blackstone to open doors for us, new clients, is incredible. And the second thing is credibility. When someone says, well, if it's good enough for Blackstone and Goldman Sachs, it must be a heck of a company. And it makes it a lot easier for us to grow and accelerate.
Yeah, I think Charlie hits a good point. Not all money's created equal, right? If you want to grow your business, if you're passionate about your idea, you need capital to make that a reality. I think one of the things we've certainly learned is you do want to look for people who are writing that check that are going to be patient, that are aligned with your vision, that are committed to you for the long term. And I think one of the things we learned is you also want to think about those investors and their ability to support the business today, but also the ability to support the business in the future. Do they have enough dry powder in their fund to write a check for your A round, but also to support you through your B and your C round as you look to grow your company? I would tell you financing can be a massive distraction to the growth of your business, and the more you can do to minimize that distraction, the better.
I'm going to stick with that last question, looking at my 4 entrepreneurs. So you're creating companies, you're focused on innovation, you're nimble, scrappy, all those things we use to describe, startups. Why the heck do you want to become the CEO of a private equity-backed company?
Well, first, let me speak. I really don't have the desire to be the CEO of Ipreo. That's what's so fun about it. The structure's there. It's in New York. I'm getting the opportunity to finish what we started. Entrepreneurship is a series of passions. We really don't have careers or jobs. We have a series of passions, and it's really nice to live out the script, because we started this business with an idea. After I'd sold my first company, I realized that as a CEO of a venture-backed company, we have no clue of our cap structure, our cap stack, the what if, keeping up with all the minutia of tracking our shareholders, shareholder rights, shareholder reporting, financial reporting to the board. And so I went out and said, let's build a better mousetrap, and then realized that this problem proliferates into the GPLP communication 4X of what we started. And it's really nice to be, as Change is, the industry leader in transparency. And we're realizing, wow, we've got a 5 or 10 year run. We're sitting around and it's San Francisco 1922. You're looking around and there's so much opportunity left and right. Let's go. And with the backing of Blackstone and Goldman Sachs, who's equally focused on winning this dream and winning this industry with Ipreo's sponsorship, it's a really exciting opportunity. And we can do it here in Nashville, which is even more exciting.
Yeah, we're going to have a special panel on, CEOs who commute. That'll be a different one we get you on in the future. So you acquired, and I'm using that word, we could have a different discussion on whether ever there are mergers. So you acquire these companies because of their innovation, and I'm looking at you, Doug, how do you keep innovating? And this gets back to the, raising before about culture, so start thinking about that.
So I think first of all, it's all a function of why you're in the business. For us, it's to fundamentally improve how healthcare is purchased in this country. And so part of why we were open to an acquisition, much like Joe, we weren't looking to sell the business. We had a number of different conversations with Emdeon over the years, and I think ultimately we realized that there was a really nice alignment of vision on where we thought the market was going and how we could influence it. From an innovation perspective, that was a big part. Was Emdeon committed to the growth that we saw on the horizon? Were they willing to invest in that? Were they willing to support us as a company? And in Emdeon's case, they brought a really unique set of assets to bear that allow us to do some fundamentally differentiated things and things that we think can actually be an accelerant from an innovation perspective, from a growth perspective for the company. And so to me, that's probably the last or the lowest on my list of concerns. We're constantly cranking out new stuff. We've got a whole host of activities that are kind of cross-enterprise in nature right now. So not really a concern, I guess, on my front.
It hasn't been for you. Frank, thoughts?
Yeah, I think we recognized when we acquired Change that there was kind of a verve and an energy there that we didn't want to disturb at the outset, but we wanted to make sure we integrated this stuff where we could get some leverage immediately, finance, HR, things like that were not as important to Doug. But we've fundamentally made a decision to leave this asset to itself and let Change kind of come to us with the ideas on how to integrate into Emdeon and leverage our assets, as opposed to coming in and taking over the business. I think we recognize that by and large, we operate more mature businesses in a different stage of life, and I think that was one of the big things in the discussion with Doug. How are you going to manage this? How are we going to integrate it? Because there is too much of a good thing, and if we over-integrate this business, we may actually squeeze out of it what we're trying to get. And so, Change is functionally operated as a semi-autonomous entity inside of Emdeon, and then kind of coming to us and saying, okay, here are the things we want to do and how we can leverage your resources, and it's actually worked quite well.
I would say just one comment to add to that. Our people are single-handedly our most important asset. And so for me, as we were thinking about this transaction, it was how do we ensure that we leave this really entrepreneurial, really innovative, fun environment intact, and we don't do anything to disrupt that. And so, day one post-close, our folks are still coming to the office. They're wearing their flip-flops and their shorts, and they're playing foosball, and they're programming in the same language, and they're riding a mechanical bull in the parking lot and all the other fun stuff we do. It's really important to preserve those things.
Doug still hasn't let me visit the company.
We wear
Where's
ties.
Where's the flip-flops? Yeah. Oh, you knew that we were having the suit panel, so you got the memo.
There's no tie.
No ties here. No ties here.
And I'll just comment on that from an investor's point of view, because at Blackstone, we own a lot of companies where innovation is important, but it's not what drives our base investment thesis. For example, Hilton, a huge company which has had a great run with a great management team through a very tough time in the crisis, Michael Stores, et cetera. Those are great businesses, but represented on the stage here with Emdeon and Ipreo are actually two of our investments where constant innovation is a key part of our investment thesis. And one of the things that we have to make a bet on and it's a very thought out, educated bet, but it's a bet at the end of the day, is that we're backing the right people that can keep that innovation going. And that's very difficult. And sometimes, quite frankly, it doesn't work out. It's worked out in spades with these companies. But that's a key part of our investment decision-making process, is that if change and innovation is a key part of the growth of the business and how we're going to make money, we got to get comfortable that we're going to have the people in place to do it and completely support them to do it.
Yeah, if I can just make one comment on that, because it harkens back to something else we said. So Robert's saying that it's all about the people. And Doug is saying it's all about the people. And I know the folks in this, and I guess everybody in the audience understands it's about the people that you hire. But when you think about who's going to invest in your business, and when you think about who's going to help you get to the next level, all money is not created equal. And you really can't even check out firms as a reputation. It really comes down to the individuals, the people who are going to lead the deal, who you're going to be working with on a day-to-day basis. And within even different private equity funds, there are different pockets. Some might fit, some might not. So a lot of times, I'll talk to entrepreneurs who will say, oh, so-and-so called me, and we're not that kind of style place, and I don't want to talk to them. Never do that. Always take a phone call from somebody who wants to invest in the business. Go have dinner with them. It's important because you can get somebody at a firm that may have a reputation of going in a completely opposite direction, but they've got an internal mandate to go in the direction you are. And if you fit together and you work together and you can get along and you share a common vision, money is just a commodity at that point. So it's one of the things that you're saying about making sure you get the right people, but it is a two-way street, and you guys got to make sure you get the right investors and sponsors involved.
Charlie, looking at you, you were acquired by Blackstone Goldman in August of 2014, and then November.
Yeah,
You did a little
we actually, our
did a
deal
little
was,
shopping.
our deal was negotiated and signed before their deal closed. So there was a lot of inside baseball, and I hadn't even realized that their deal hadn't closed yet, which was kind of funny.
No, that's okay. I love this. All right, we get all the other scoop, but there you are kind of acquiring these guys and integrating. What are the integration issues? Because you yourself have just been, kind of integrated into Blackstone, so to speak.
So that's a great question. I would say the number one thing there's the nitty gritty that we all know around the cost synergies and what we're going to do with the office space and kind of the boring stuff. What's I think critical is the culture, right? What Joe is stepping into as an entrepreneur who's been doing his own thing, being owned by Blackstone and Goldman Sachs comes with a lot of reporting, a lot of governance, a necessary change and an impact to the culture, even as hard as we're trying to keep it the same. And so I think the integration challenge that we think the most about is how can we make sure that we position Joe in this new normal to be as successful as possible and keep doing exactly what he's doing.
Thank you, Charlie. Charlie helps me a lot because I will tell you the demands. Now I've always had a structured board. I've built several companies. I've been venture backed. I've raised a lot of capital in my life, and I've always been fiduciary responsible and pride ourselves on monthly reporting and proactive reporting. But I will tell you the demands of the reporting of a Blackstone Goldman team is unbelievable. And they're very, very smart people. And it's interesting, I had to go up and present to the Goldman Blackstone team, about a month ago, and Charlie and I were there, and there were 16 folks in the room. And I felt like I was on a bit of a congressional panel.
Were they nice?
They were very nice, and the Blackstone people were fantastic, and Goldman is Goldman, and they were great. There were...
That's a tweetable moment.
Sorry,
Goldman is Goldman. Yeah.
400 questions on your business. And it was awesome. I loved it because I get to talk about the business and sit in a room for 4 hours and answer 400 questions. But the energy, and what I realized halfway through that was these folks are so engaged in our business right now, and the opportunity we get as a result of those 16 folks focusing on our industry, our infrastructure, the processes, the people, the technology, the knowledge, it is just fantastic with the opportunities that bring. And it just goes to show, to be number one and be the industry leader, it takes a massive commitment. And it's exciting.
So that intensity keeps going. So the people keep coming back up as the important thing. Robert, let me go back to you and to start off with this question. How do you keep, you bought these companies, how do you keep these guys? How do you keep the CEOs of the companies that Blackstone acquires?
Well, I think there's a couple of different ways. One is to be brutally honest, we try and set up the deals so that if the CEOs accomplish what we all want to accomplish, they'll make a lot of money. That's certainly one way to do it.
Money's a good motivator.
But again, I don't want to sound too repetitive or too trite. We just try to be good partners. Because again, we're buying into existing businesses, existing business plans. We always think we can help out do something, and that's actually a key part of our business. But we don't think that our job is to come in and basically change a business. So we want to come in and support and give all the support we can. Again, invest more capital. A lot of times companies need capital to make acquisitions, to grow organically, to hire people, et cetera. So we're there for that. And we want to keep the CEOs engaged and excited about the businesses that they're running. And again, it doesn't work out all the time. Most of the time it does. But it's the most, you've heard several of us say this today, the people part of what we do, the business has to be good, the business plan going forward has to be good, but just as critical to us is who we're investing behind. And it's got to be a partnership, and everybody's got to be satisfied that you're moving in the same direction.
Right, got to keep them motivated and keep their teams motivated.
Hey, Kelly.
Yes?
Hey, I'm out here in the audience.
I'm like, who?
Hey,
yeah, there we go.
Hey,
Awesome.
over here.
There he is. This is sort of
Sorry to interrupt you, but I want to know if we could take 5 minutes and do some audience Q&A.
I was going to put that out there. Can we do that?
Yeah, I would love to do that. Would you guys like to do that? Anybody have a question for Kelly and the panel? Step right on up.
Or someone can take a call. I hear a phone ringing.
This is an awkward moment for everybody.
Come on, someone's got to have a question. We're not that shy. Come on, Nashville. You can do this. Well, fine then. Yay! Woo! We should have warned them we were going to do this. They could have gotten their questions ready.
A couple of days ago, there was a story in the New York Times that was saying with organic growth gains relatively hard to achieve right now, that more sponsors are wanting to get their platform companies to do more M&A. Could you comment on that and whether, I know Joe's got a pipeline and Ghertner probably does too, but how about talk on that?
So I think I disagree with the article a little bit in the sense that in 2012, Ipreo was worth $400 million. Today we're worth about $1.2 billion, and that's been driven purely by organic growth year over year. So I think in the certain sectors, whether it's health tech or fintech, that organic growth is still very much possible. That being said, for us to achieve what we want to achieve, the inorganic part has to be a big new component to us going forward. And so that really was a driving force behind the acquisition of Shareholder Insite.
M&A has always been an important part of our strategy. I think people are coming around to it in a different way now, I think more broadly in the marketplace. We sit in the center of healthcare, connect to everybody in the industry, and virtually there's almost nobody in healthcare who isn't a customer on a payer, provider, or pharmacy basis of ours at some level, and sometimes also a competitor. We've done 16 acquisitions since 2008 when I joined. About a third of the company probably wasn't there. At the same time, we've continued to grow organically, probably in the mid to high single digits year after year, and we're accelerating that now. So it's kind of a blend of both. I think in some ways the market's catching up, but if you're running a business with decent organic growth characteristics, you can always amplify it, especially if it's got tentacles into a lot of areas with acquisitions, and that just kind of serves to reinforce the organic growth rate as you go along too.
Great. Next question.
Yeah, thank you. I'm curious about how important marketing and branding is in your evaluation versus technology and culture and people, and how that comes into the mix when you're looking at your purchases and investment.
I think for us, it was interesting. We found ourselves in a space where all of our other competitors were incredibly well capitalized, likely more well capitalized than we were. Marketing and branding, to the degree that it's driving sales and growth, is absolutely critical. That being said, I can tell you from the diligence efforts that Emdeon put into our technology platform, you've got to have both pieces of it. You can't just be all smoke and mirrors and a really good story. You've got to have substance behind it. To Frank's point earlier, I think part of what helped them get comfortable with a fairly non-traditional transaction here was the fact that we'd gone from 200,000 lives on the platform to 5 million to 8 million, and today we sit here with 12 million. So they were seeing the traction. They saw a platform that actually was able to support that growth and where we were today and where we wanted to go in the future. And then they liked the story. But I would say it's got to be, you've got to have each of those pieces.
Great.
I would just add that for smaller companies that we look at, the most effective form of marketing is their clients.
Yep. And I'll just add real quickly, because it's less applicable to the companies that are represented here, but we do own companies, again, like a Hilton, like a SeaWorld, like a Michael Stores, where branding is hugely important, and what you do with the brand and how you can use the brand to increase value. I think it's somewhat less important with what y'all do, although your brands and marketing are very important. But in those types of businesses, for us, it's hugely important.
Yeah, I would say anything that's truly consumer-facing, and the importance of the marketing and branding in those situations. Our next question.
You all have talked a lot about culture as a part of the acquisition process. What kind of cultural due diligence do you do?
So There's a number of things we do. I think the dialogue usually starts at a senior-most level. So from our perspective with the change guys, Doug, I was involved in some of these discussions as well, but Doug and our CEO spent a lot of time one-on-one. And it's really going out and making sure that you share that common vision that we talked about earlier. When we're going through the diligence process, it's more just, there is a whole set of our HR folks going in and assessing the culture and reporting back, and there's a great discipline around that. But a lot of it is just, it evolves over time as you go through it, and you kind of feel as you're talking to people that they've got a common way of looking at the business and working together, and you kind of, as you go through the process, things start to fall into place and you feel good about it. And if things aren't falling into place, you'll kind of see the culture start to come apart too. So the way in which people conduct themselves in those discussions, because some of it's going to be foreign to them anyway, they've never kind of sold the company before, that kind of comes through in implicit ways for us. And you just got to, for me, it's the HR folks do their stuff, that's discipline, but the other piece of it is making sure everybody on the team understands that part of your job is to come back and say, do you think you can work with these folks once we get the deal done?
Yeah, I mean, maybe I'll pick up on that comment that you're making, Frank. Like, when do you start telling your teams? Because part of this, with terms of the culture, right? You guys need to know who your employees are, how your company works, how you're communicating it to each other. But how do you then start getting your team and these important people on board that this is going to be a good thing?
That's always a challenge, and you never have 100% success. There's a lot of people that like startups, they like really small companies, and the second they see the new owner, they run for the doors. It's always a challenge. Integration it can be difficult. A lot of people don't want to see how the donuts are made, and it's just a reality to integration. And you stand firm, and you want to make sure when you're joining. I've done it a couple ways. I've sold and left, but this time, the real key to me started with LT and the culture he had with the two kind of founders of Ipreo. They've been together for 19 years. And they had a real camaraderie, and it was a great culture to join. Very competitive, very transparent, very brutally honest. And I liked the guys the second I met them, and that was key. I said, I really like these guys, and we could have a lot of fun building this business together and the commitment. So culture is really, really important. We've kept our culture in Nashville. They love it. New York comes down all the time. We're in the Cannery Row building with flip-flops and T-shirts and the same culture you have, and we're not going to change it. And we were never asked to change it. Ever.
Thank you for
never,
putting
ever,
on
ever.
socks and shoes today.
Never asked to change it.
That's great. Fire away.
All right. In your opinion, as a seed stage startup, what are 2 or 3 things that we can be thinking about now as we're growing and looking at M&A down the line or private equity down the line? What can we be doing now to keep that in the back of our minds and be prepared when that phase comes?
Well, that's a great question. I've built a few, and I'm on the board of a bunch and invest. I do a lot of seed investing. And the one thing I always say as an investor and a board member is find your 2 or 3 biggest partners and start forging that alliance, building that relationship, because you're going to have to pick at one point. They're generally going to be 2 or 3 industry leaders that you'll end up, you may stand alone and like an Eventbrite, be a disruptive category killer and be able to be an independent platform. Or you may have to join a larger platform. And as I say, start courting 1 or 2 of those bigger partners. Get to know them. Reach out to their CEOs. Talk about strategy. Don't be scared. And the other thing I say is, don't be cagey with your idea. You got to be transparent because you need all the help you can get, without a doubt.
Yeah, I think from my perspective, what I would say is, one, you've got to make sure you're passionate about whatever it is that you're doing. And it's something that you believe in, because it's going to be challenging for however many years it's going to take. This stuff isn't built overnight. I think the second is really just thinking through, how are the incumbents in your space going to view your business? If it's disruptive, how are they going to behave? How are they going to react? They have a tremendous amount of market power and market influence, and they can single-handedly look to do things that make your life more challenging. And so thinking about what does that look like? How do you war game those different reactions from the different stakeholders in the market? To me, those are probably the 2 biggest things.
Great. Thank you, gentlemen. Very insightful. Everyone got a word in. We were wondering if that was going to happen. All right, thank you all.
Okay.